I am delighted to share with you today my job market paper, which examines whether the earnings targets used in long-term compensation plans predict performance. A fairly recent development in the world of executive compensation is that more and more firms are conditioning their long-term executive pay on accounting performance. That is to say, the shares that vest or the cash awards that are paid out down the road are increasingly determined according to an accounting benchmark that's decided at the time of grant. Now, these benchmarks or targets are determined by the firm, so they are inherently subjective. They also refer to a long performance horizon and are disclosed in the annual proxy. On the surface, these targets look a lot like long-term forecasts of future performance. And the question I ask in this paper is, are they? Are they actually forecasts? And I find that the answer to that question is yes, and I find that the answer is yes in two parts. So first, at the time of grant, I find that targets are set in such a way so that they predict long-term earnings surprises, suggesting that the firm is actually using its internal information about its expectations when setting these targets. And second, I find that later, upon disclosure, targets actually provide information about long-term cash flows to outsiders. In fact, I even find that analysts revise their expectations according to the information in targets. Now let's first look at an example taken from McDonald's Corporation's 2012 to 2014 long-term incentive plan. At the beginning of 2012, McDonald's sets a 3-year cumulative EPS target of $17.82, representing a 6% compound annual growth rate. Now, this performance on this target won't actually be assessed until, even though it's set at 2012, won't be assessed until 2014 because this is a long-term or long horizon target. Presumably, though, McDonald's considers this goal to at least be an achievable one, or else really why would it use it at all in its compensation plan? Yet, even if this were a perfect representation of the company's beliefs or expectations at the time of grants, it's not actually disclosed until much later when the proxy is filed, in this case in April of 2013. This is a full 13 months in between when the target is set at grant date and when it's disclosed. And in that time, the environment could have shifted or the firm could have made its expectations known through other disclosures. So it's not clear at all that even if the firm was basing the target on its expectations at the time of grant, that it would still be informative by the time of disclosure. And this is why I asked the question in two parts. Now, you might be asking yourself, why wouldn't a target be a forecast? Why wouldn't it have something to do with long-term performance outcomes, given that it is the stated firm goal? And one reason for this is that targets could essentially just be a disguise for low-risk pay. In fact, up until recently, the tax code provided an incentive for firms to use targets in order to satisfy tax deductibility requirements. So if firms are just using targets to get the tax deduction, I would expect them to be set artificially low and really not have much to do at all with their expectations. In addition, although we can think of targets in terms of achievability or the probability of achievement, it's really not clear at all where within the range of achievability these targets fall. There are arguments for targets that are set well below the firm's expectations as well as well above. And without really knowing much about the firm's goals in setting these targets, it's really hard to tell from an outsider to what extent those targets correspond with the firm's expectations. By and large, these factors are going to work against my ability to show that targets are indeed based on the firm's expectations. Nevertheless, I do predict in the first hypothesis that as of grant date, firms set their long-term targets according to their expectations of future performance. And secondly, because of this significant lag, it also might be hard to show that these targets even provide any useful information to outsiders. But I do predict in H2 that upon disclosure, long-term targets will provide information to outsiders about future performance. I use ISS Incentive Lab for this analysis. Incentive Lab is the only database that I know of that actually includes the specific quantitative targets used to assess pay. Unfortunately, Incentive Lab does not include the specific disclosure dates for each target, so this is something I hand collect. Now, firms use a variety of types of earnings-based targets. They're by no means standardized. So in order to compare apples to apples, I convert all of the targets in my analysis to a measure of net income over assets, or ROA, for the third year of the performance plan. And I use the third year because as of disclosure, the third year is entirely in the future, and it still represents a long-term horizon for which most firms don't give regular disclosures for, or expectation disclosures for. Now, this analysis really starts with the framework that budgeting information, or the expectation information, is fed through the compensation design process to arrive at a target. And to the extent that that budgeting information is predictive of future performance, and to the extent that the target itself closely maps to that budgeting information, then I expect the target itself to have some predictive power when it comes to future performance. Now, in order to get a measure of the internal expectation of the firm from the target, I compare the target to a measure of outsider expectations, and I proxy for those using the consensus analyst forecast for the same performance period. Now, if H1 were to hold, that is, as of grant date, firms are basing these targets on their expectations, then I would expect those targets, the difference between the target and the analyst consensus as of grant date, to predict future earnings surprises, or the difference between the actual performance outcome and the analyst consensus. So beta greater than 0 in this regression I take as support for H1. I do the same thing to test H2, only now I update the analyst consensus to be that of disclosure date. So to the extent that the firm has already made its expectations known through other disclosures, I would expect this updated analyst consensus to reflect that. If the information is still useful, then I expect the difference between the target and the consensus to continue to predict future earnings surprises. I would also expect the difference between the target and the consensus to predict revisions of the analyst consensus around the disclosure dates. Tests of H1 find that, by and large, targets are predictive of future performance as of grant date. So about a 1 standard deviation difference between the target and the analyst consensus predicts at about an 11% standard deviation positive earnings surprise. Later, upon disclosure, I still find that this difference, the difference between the target and the updated consensus, continues to predict earnings surprises. And in the last column, I also show that they positively predict the analyst revision around the disclosure date. So to summarize the findings, the paper shows that these long-term targets actually do have some forecasting capability, in that as of grant date, they're associated with future performance, and they even provide information to outsiders upon disclosure. I think this paper has the potential to provide a number of contributions. So first, by finding that targets are an outcome of the firm's internal information or budgeting process, it further lends support to thinking of targets as actually a tool to provide incentives rather than just mere window dressing. Second, it's my hope going forward that as these targets are used more and more, they'll continue to provide us with insight into the firm's internal information processing, both in terms of content and accuracy. And last, I think this paper provides some really compelling justification for thinking of the firm's overall disclosure policy within the compensation design process. This paper, to my knowledge, is the first to show such a direct, almost a substitutive relation between compensation disclosures and financial disclosures. And frankly, I think it will be difficult to consider those two in conjunction going forward without also considering the findings in this paper. Historically, in accounting research, we've thought of financial and accounting and even disclosure decisions in the context of incentives. My paper is one that demonstrates that incentives themselves are not designed in a vacuum. There are likely a host of other factors that have yet to be explored which affect the compensation and incentive design process. And given the changes we've been seeing actually in recent years around compensation design, along with the enhanced data availability, I think this is a really exciting time to be doing work in this area. Thank you. Thank you.